This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today,
we're going to take a look at how a potential Iran deal could change the global oil market.
Plus, Amazon could end the year as the biggest spender in the streaming industry. Could that lead them to gain enough subscribers to leapfrog Netflix or Disney in the streaming wars?
But first, we want to take a look at the credit market. Many analysts over the past few weeks have said that the credit markets are not accurately reflecting the kind of tightening that we're going to see from central banks. So to learn more, we want to welcome Bloomberg Intelligence Chief European Credit Strategist Mahesh Bhimalingam. Mahesh, have we in a credit market priced in, say, a 75 basis point hike from the ECB?
Thank you guys for having me. A very good question. In terms of spreads, we've had a big rally in July. You know, it's been one of the best months since pandemic recovery after the disaster we've had in the first half. But in August, we have given back quite a bit of the gain, in fact, almost all of it. So to answer the question, is the market pricing in the ECB's hike? I would think so. And I think from previous inflation concern and probably borrowing cost concern, now we are pricing in recession concern. So spreads have gone up more on the CDS side, less on the cash side, but nevertheless, spreads across the board in both investment grade and junk are wider in August.
All right, so Mahesh, I think what we're hearing a lot more about from economists is not so much inflation, maybe that's peaked, but the risk of recession. So as you think about the high-grade corporate credit market, how does that market set up now for what could be, in fact, a slowing environment?
Yeah. So we've discussed this in detail in one of our recent publications on bond index fundamentals. It's probably the only one of its kind on the street. And what the numbers show is in the second quarter, if you look at credit metrics, whether it is leverage, net debt to EBITDA, or whether you look at coverage, interest by EBITDA, or whether you look at gearing, which is debt to equity. On all three measures, you are seeing gentle slips. It's not massive because we are looking at Q2 earnings, and hence credit metrics have deteriorated slightly. I think the big slide is probably going to come in 3Q. Now, so I think all the pandemic recovery gains are done. Clearly, if you look at any data we've published, it can show on the leverage side that we've hit the trough and now leverage is increasing. On the coverage side, we've hit the peak and it is dropping. And on the gearing side, we've hit the trough and it's increasing. I mean, given that the measures are either numerator or denominator dependent on earnings. So clearly, slippage started, but I think the big slide is awaited.
Well, but okay. How does then you factor the energy crisis into the corporate bond market? Is that on an index level or is that in a specific industry bond market level? How do you look at the continued rise in energy prices? Even though we've come off the highs, it's still so elevated and the crisis is still right around the corner.
Now, probably you guys sitting in America haven't seen what an energy crisis properly looks like. If you look at Europe, it's a complete disaster across the board, except in one or two countries like France, where they have probably capped it for the retail market, and also they have alternate sources like nuclear power. Other than a few countries like that, the wholesale energy prices have just gone through the roof. We are talking about like 300%, 500% increases.
Yeah.
So compared to what you guys see in America, is much worse here.
I don't know. My bill was $400 last month to turn on the air conditioning.
You've got no idea, Alex, what's coming up here. People are going to go bust, trust me, along with what the central banks are doing. Now, how much of that has filtered into corporate metrics? As I said, in the second quarter earnings, which are just finished basically, they have filtered through a little bit in terms of costs, because you see, energy may not be a direct input into all the corporates, but it is an indirect input. In quite a few, it is direct, particularly on the cyclical sectors and so on. But even in the non-cyclicals, even in like tech and communications and so on, it is indirect, because electricity is an input and so on. Or even electricity pricing has gone up because quite a bit of electricity production in Europe is through gas, and gas, what has happened thanks to the war and so on. So it is filtering, and also interestingly, if you look at how sectors have been thrown off in terms of trading wide to the rest, peculiarly, the natural gas sector, companies that actually distribute natural gas, those have sold off quite a bit. So natural gas looks really wide to leverage. Energy also looks wide because there are energy distributors here, not so much production. So, that's even within sectors, there is a bit of, dislocation. So the non-cyclical sectors look tight, and the cyclical sectors where energy is a direct input, whether it is through, electricity or through gas, they have sold off a lot.
Mahesh, we really appreciate it. It was a great setup. It really helps us also understand the credit market as we head in to Thursday of next week. Bloomberg Intelligence Chief European Credit Strategist Mahesh Bhimalingam.
Coming up on the program, we dive into the Fed. After a busy month, what should we expect for September? We discuss next.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, I think the Federal Reserve has certainly done its job in communicating that, guess what, folks? They are going to raise rates. They are focused on inflation. That is top of the list. Let's get the latest on that with Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey. Ira, it's, we're into September. It's not too early to start thinking about the September meeting. I guess the only decision is, do they signal that if they do raise rates here, which most people believe in September, will they pause or will they keep raising rates? What do you think we're going to get from their September rate decision?
Well, ultimately, at the Jackson Hole, you had a preponderance of members of the FOMC that said we're going to be raising rates even into 2023. So now the pace of that will matter at some point because that will determine how high those interest rates ultimately get. And I think we still think here at Bloomberg Intelligence that the market is pricing too low of a Federal Reserve terminal rate. So whether or not they go 50 or 75 at the September meeting, we still have a lot of data to get through before we get there. We get another CPI report, we get the retail sales report, and all of the other little ones in between as well. So I think that there's going to be some changes to the pricing, and whether or not we actually price 100% for a 75 or we price for 100% for a 50 will be heavily influenced by the data over the rest of the month.
What's the terminal rate that you guys see?
Yeah, so we're looking for upwards of 4.25% to 4.5%, so more than the market's currently anticipating. And I think one of the big reasons that that's going to be the case is because we will not see inflation decline, particularly core inflation decline at a pace that's going to keep the Federal Reserve happy. So I think that they are trying to thread this needle of, look, we don't want to go too far where we cause a really bad recession, but at the same time, we want to be able to hike enough that inflation will come down enough and will slow aggregate demand enough for it to come down. And when you have strength in a lot of sectors starting to turn, so look at this past week's ISM manufacturing numbers, like that actually went up. And you look at the new orders component, that's above 50, which shows growth. So a lot of the data that we're starting to see is very muddled and does suggest to me that there's going to be renewed strength in the economy going forward, and that's something that the Fed ultimately, I think, will worry about.
Ira, when you talk to traders and things like that, and you're in the market every day talking with people who actually do this stuff for a living, what are they kind of pricing in terms of this Fed? Will the Fed get it done? Will the Fed be able to negotiate some type of soft landing? Or do you feel like most market participants are saying, hey, a recession's coming, it's just kind of a question of, how deep?
Well, I think everyone thinks that a recession is coming. It's a matter of both how deep and when, right? So is it 2023 or is it 2024? And market participants that I speak to are very bifurcated. So there's a whole group that says the Fed is still behind the curve. The Fed has to hike to. I even heard one person say this past week that they thought that the Fed had to hike to above 5% to 6% or 6.5%. And then you have other people that say the Fed can't go even as far as the market's pricing right now because there are some indicators that those folks watch that are starting to slow down significantly, and they think that we might already be in a recession, right? People who say, oh, we've already seen 2 quarters of negative GDP growth. We're already seeing some weakness in the housing market, for example, that's going to permeate through the rest of the economy. But then I look at things like the retail sales numbers, and those were good. So, especially excluding gasoline. There is a bifurcation in the market right now. So I think everything that's being priced is kind of the median of those two disparate camps.
Yeah, it really feels like literally no one knows what the consumer is going to do. And like if we knew that, then we could probably sort a lot of different things out. But like no one actually knows how much we're going to spend and what we're going to buy on. I feel like is one of the issues. Okay, upside 2-year. How quickly do we get to your upside target, and what is it?
Yeah, so our upside target is 3.85% right now. That's before year end this year, and I think that'll probably be the peak in 2-year yields. And again, that's predicated on our view that the Fed hikes to 4.5%, and so I think it can happen pretty quickly. You know, the Fed goes 75 and hints that it might go 50 in November, and I think that we can sell off pretty aggressively in that front end, in those front end yields, and we're already, above where we have been since the global financial crisis in terms of 2-year yields. So I think that will tighten financial conditions, and that will be something that one of the goals of the Fed, and that's one of the reasons why the Fed, might want to hike a little bit beyond what it's already done.
Is it still fair for someone to criticize this Federal Reserve as being behind the curve?
That's a good one.
I think you can argue that, but it's really perception, right? So given that we have 8.5% inflation, you'd say, yes, the Fed is behind the curve. I mean, we still don't even have, when you look at the federal funds rate right now at 2.33%, that means that the real Fed funds rate is still massively negative. And one thing that we've always noted here in the rate strategy group at Bloomberg Intelligence is, look, the Fed has never stopped hiking until the real federal funds rate has gotten to zero. So that's one reason why, 4.5% to us makes sense, because we think that we'll get year-on-year core inflation down to around 4.5% in the second quarter of next year. If the Fed hikes to 4.5%, 4.25%, somewhere around there, we'll be close enough to that real Fed funds rate being neutral, being zero, that the Fed will be able to stop hiking, and then it will be on hold for some period of time, whether it's 6 months or a year, until they actually see the core inflation measures in particular get back down toward their 2% target.
It's a dumb question, but when you say real Fed fund rate, that's not the real 10-year yield, right?
No, I mean literally the federal funds rate, which is now 2.33%, being equal to, I would use the core PCE deflator because that's what the Fed looks at, and the core PCE deflator is still well above 4%. So until that particular measure rolls over and equals the Fed funds rate, the Federal Reserve will likely continue to hike.
Boy, I learned so much talking to this guy.
I know, right?
I know, he kind of knows what's going on. So what's the thing that this Fed could really just throw a monkey wrench into everybody's plans here in September? I mean, is there any risk that they do something really outside the bands of expectations?
There is a non-zero possibility that they actually hike even faster, right? So that they hike 100 basis points. I think the other out-of-the-box thing that they might do, that they could do, I don't think they will. But given how slowly refinancings have occurred in the mortgage-backed securities market, that's really slowed down the runoff and the amount of prepayments off of the Federal Reserve's mortgage portfolio. So people just aren't refinancing. There are also not a lot of new home sales that require people to pay off their old mortgages.
Good stuff, Ira. As always appreciate your time. Our thanks to Bloomberg Intelligence Chief U.S. Interest Rate Strategist, Ira Jersey.
All right, coming up on the program, there is a potential Iran deal on the horizon. If it happens, it could make a very big difference in the global oil market and the supply picture. We're going to find out just how much of a difference coming up next.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 25 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
Let's take a look at the commodity market for a moment. There's lots of wild cards, but one that I feel like has gone underappreciated has been the potential of a next Iranian deal and then the return of some Iranian barrels of oil, which could really throw off a lot of the fundamentals within the oil market. So let's get some more details here from Salih Yilmaz. He's Bloomberg Intelligence senior energy industry analyst. What's the deal that could potentially come to pass?
So this is what we're waiting to hear, basically. But I should say that I can count at least a couple of times in the last year or so where we thought an Iranian nuclear deal was imminent, but didn't quite happen. So what we're waiting to hear is a potential deal between the parties that would allow Iran to export more oil. And this is important for the oil market at the moment because we estimate between 1 to 1.3 million barrels per day that Iran could bring back to the market relatively quickly and front-loaded, we believe, back into the market probably around 9 to 12 months following a deal. And we currently have, I know oil prices have been falling in the recent weeks, but we do have, many agencies agree that we do have a tight oil market, which may actually get even tighter towards the end of the year. So that's why I agree with you that this is one of those wild cards that is increasingly important because this really could take the oil market that is very tight, that is probably in a deficit, and flip it into a surplus.
Wow. So if an Iran deal can get done, where is the oil industry in Iran in terms of where their capacity is and kind of where they are in production now? Can they crank this thing up in a reasonable amount of time? And do they have capacity?
This is a big question, and as far as we know, there aren't any big issues with any of the big oil fields that need big repairs or anything like that. And I should mention that when we look at the 2016 period, the last time Iran was able to ramp up its exports, it basically managed to ramp up its exports way faster and way more than all analyst estimates. So basically in the 6 months following the JCPOA in 2016, late 2015, we saw them increase their output by more than 500,000 barrels per day. And we expect them to be able to do the same. We don't really have a reason to believe that they couldn't do that this time. And I should mention, very importantly, is, how quickly they can ramp up output is very important. But we know that they're actually sitting on a lot of storage as well. So the estimates are around 100 million barrels of crude oil and condensate, which would allow them to ramp up their exports even faster than their production level.
So the three things that I have problems with. One is that I feel like the U.S. administration is much less likely to do this now that gasoline prices are under $4. Two, if I was the Iranian government, I don't know why I would trust the U.S. government again, considering what President Trump did when he just ripped up the agreement. And three, I would think that President Putin, that does have close ties with Iran, will do everything he can to keep the oil off the market to keep high oil prices so he can make more money.
I think you summarized this really well, and these are huge concerns, and especially on the Iranian side, the lack of the continuity guarantee, I think, remains the big issue, because they're saying that, if the administration changes, this is not a legally binding agreement, and there is no guarantee for us that this would continue when, if the administration changes. And arguably, there are incentives on both sides to just have the talks drag on, because, in this way, Iran kind of avoids deeper sanctions, because while the negotiations are ongoing, they don't have any deeper, perhaps secondary sanctions. And similarly, U.S. is also incentivized to do the same, because if they brought stronger and deeper secondary sanctions, this really could risk a deeper oil deficit, in turn increasing oil prices. So I think the way things are, and this is why an Iranian deal is not in our base case and our core scenario, because we think there are some issues that remain, and we think the current situation of having the talks drag on is actually beneficial for both sides.
All right, just a sense of timing. When you talk to market participants, do they feel like we'll get resolution one way or the other? We'll either have a deal or won't have a deal. Is that something we'll get in 30 days or something like that? Or is this something, as you suggest, might just drag on?
I mean, just recently, President Macron of France said that it might be imminent. But as I said earlier, I could count at least two times where we heard exactly that in the last year, and then nothing came. And then, I mean, last week, we really thought a deal was around the corner, and then it wasn't.
Salih, thank you so much. Really appreciate it. Salih Yilmaz, he's a Bloomberg Intelligence senior analyst.
Coming up on the program, we turn to tech. Apple is preparing to launch a new iPhone in September. We discuss the potential sales impact the new release might have for the tech giant.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, it is September. That means it's time to get some new cool products from our friends in Cupertino, California. That would be Apple. I think they might even be bringing out a new iPhone. I can't recall. I still have an iPhone 11, and it does just fine. All right, let's bring in Bloomberg Intelligence senior analyst Anurag Rana. All right, Anurag, I understand Apple's coming out with a new phone. Do I care? Do investors care? What's the latest?
So the best way to think about it is it really matters that you're going to rush out and get the latest and the brightest. But this is not the latest and the brightest. This is just a series of a smaller upgrade cycle, which is the iPhone 14. The form factor would be very similar to the 13. So for people like me who like to rush out and get the phones immediately as a new one comes out, I'm not going to be doing it this year. But for the normal world who's probably on, 10, 9, 11 maybe, they may upgrade it. So our math says it's not going to be a needle mover, frankly, this year.
So are they counting on it to be? And if there is strong demand, can they actually meet it?
So the way we model this, Alex, is that Apple has right now an install base of about 800 million phones across the world, which means, and these are the ones with cellular plans. And if you were to say that the average life is about 3.6 years, that means even without enticing new users, they're going to sell about 220 million units, 22 million units every year without any issues. Now, if the economic activity around the world is not very good, then people may push out 6 months, 12 months, but sooner or later they will upgrade it. So from our side, that we think that the next year is going to be when people rush to go into the 14. Now, as far as the supply is concerned of parts, which has been a very big problem for Apple in the past year, so far we have heard that things are okay. We are back on schedule for almost all of Apple products at this point.
All right, Anurag, you've got a great chart in your research report just kind of showing where Apple gets its revenue from, and 43% comes from China and Europe. Both of those regions very unreliable, having some real tough economic situations, whether China's locking down its country every other day and Europe's dealing with a war and all the economic uncertainty there. What's the risk?
So that's where we think that it is not going to add a monumental number of new units to Apple's install base. You may still get a little bump because the Pro models or the new iPhones usually come at a higher price tag. So even if you are a little short on units, you can make it up on the pricing part of it. So which is why we think, the iPhone sales growth for next year, next 12 months is not going to be more than, 2% or so, because of the reason that you suggested is both Greater China and Europe account for 43% of total sales for Apple.
And then to the supply chain point, how is the supply chain for Apple? I know you said it wasn't going to be a huge mover or anything necessarily this upgrade, but if there was the demand, could Apple actually meet it? And where are still the breaks in their armor on that? And how are they going to manage that going forward?
So one of the things that we have talked about is Apple is extremely dependent on China for almost all their assembly. Nearly 100% of the phones are assembled there. So any problems in China because of COVID lockdowns or any other issues, it has a direct impact on Apple and its revenue recognition. But, as I said, last time we were very encouraged when Apple said, listen, things have opened up for them and they don't see any problem going in. Now, longer term, we think Apple needs to diversify away from China into newer regions, whether that be Vietnam, Mexico, India, anywhere where they can get parts and assembly done if for some reason they can't get it out of China.
So I'm just thinking about is it too early to start thinking about the iPhone 15? Is that because I've heard some folks say that's really where we're going to see something new maybe?
Yeah, we think that's going to be the big kiss. Now, and the surprise factor is going to be whether they do a foldable phone at that point or not. Samsung's already out with one, and it's
what would be an affordable phone? Would it be like $300?
Foldable phone.
Foldable.
Foldable.
I said affordable, and I was like, when's Apple been affordable?
No. It is. I personally don't like having a little line in my phone in between that can be folded. But to be honest, if you look at the Samsung ads, it is really catching up. And our last conversation with IDC, they say that they're going to do a separate segment on foldable phones going forward. So that could be the big factor. Obviously, the phone will look completely different than what we have right now. Those are the times when people wait to get upgraded. So, for example, I will wait to get a completely new shape of a phone at that time. And that really, we think, is going to bump up the iPhone revenue somewhere in the 7-9% range because of both an increase in unit shipments as well as the price points.
And I know I'm harping on this, and I don't mean to, but when you talked about the supply chain and how they get so much of their supply in the phones made in China, if they have to onshore it or reshore it, does that change their margin profile for stuff?
Yeah, first, it will change the margin profile by a huge amount.
Okay.
Second thing, it's actually not even physically possible to do that because of the number of people required to do it. I think Foxconn has over 1.5 million people working in their factories at this point. So that's the second thing. We think the only way they could onshore that to a developed country where you don't have to pay that much higher wages would be automation and robotics. That's the only way when a robot is assembling the phone, you really don't need humans to do it. I don't think we are anywhere close to that at this point.
Really great stuff. Love talking to you. Thank you so much, Anurag Rana, Bloomberg Intelligence senior analyst. From Apple now to Amazon. Amazon is pouring tons of money into their streaming platform. If you're a sports nerd, you got NFL. If you're a me nerd, you got Lord of the Rings. How much will they actually be able to spend on it? Can they surpass Disney and Netflix? Want to bring in Bloomberg Intelligence analyst Geetha Raghunathan. How much money are we talking about? I mean, I look at the Lord of the Rings trailers because, like I said, I'm a nerd. I mean, that's really good. I mean, I'm thinking how much money they shelled out for that kind of stuff.
Okay, get this. This is the most expensive show ever made.
Oh, boy.
They spent about $500 million in production costs and $250 million for the rights. So we're looking at, upwards of $700 million just for the first season.
Oh my gosh. Is that going to pay off for them?
That's the hope. So, this is really, I think, coming at such a pivotal time in streaming because you have everybody else kind of really pulling back. And then you have Amazon kind of coming out all guns blazing. And they've made a lot of very interesting bets throughout this year. So they bought the MGM studio for $8.5 billion. Now then they went after the NFL Thursday night games. Again, this is the first time that, football will be on a streaming service. And then now you have Lord of the Rings. So I think they're really hoping that it is going to pay off for them in a big way, both with Prime subscriptions, acquisition and retention, as well as kind of getting more and more ad dollars onto their streaming platform.
You have a chart in here, Geetha, in your research report that just kind of has what everybody's spending for all the streamers, and it comes up to like $65 billion of total content spend. We had, and that for the last several years was, I guess, kind of the strategy, just try to get as many subscribers as you can by just putting on the best content you possibly can afford. Now that's kind of changed a little bit. David Zaslav, who runs Warner Brothers Discovery, he made a real pivot recently by saying, hey, we got to make money at this stuff. Talk to us about where we are in just the streaming economics, if you will.
Oh, yeah, that has, Paul, that has become the most important word over the past few quarters. What is the endgame economics? Is this business going to be as profitable, as the old linear TV, the cable TV model? And yeah, you're absolutely right. It was first all about a numbers game in terms of subscriptions, and everybody was chasing subscribers. Doesn't matter how much money you're spending, but it has come down to profitability. And now we have all of these companies taking a very cautious stance. And when you have somebody like Netflix do that, yes, you mentioned Warner Brothers Discovery, but when you have Netflix coming out and saying that they are holding their content budget steady for the next 3 years, then you really sit back and wonder, because this is a company that was used to writing, huge checks, spending really the big bucks in Hollywood. But all of these companies, so whether it's a Warner, whether it's a Netflix, whether it's a Disney, they are all becoming more and more cost conscious. They are focusing on profitability. And a lot of these discussions have now shifted away from just subscriber metrics to kind of operating margin and when they're going to be profitable in terms of their streaming business. And Zaslav actually said, we don't want this to turn into the spending wars. We want to be careful. We want this business to be ultimately as profitable, if not more, than the old model.
See, this is the crazy thing, is that if you take a look at Amazon on the terminal, the classification is still an online marketplace. Do investors value and want it to be a streamer? And does it command a different type of valuation or way to model it if they still look at it as an online retailer?
So I think Amazon is really looking to become more of an ecosystem. So streaming is a great way for them. So if you just look at Prime subscriptions, one of the main reasons they have more than 200, maybe about 200 to 250 million Prime subscribers worldwide. And a lot of the surveys that have been conducted have actually pointed to, of course, free shipping is a huge attraction. But a lot of those survey respondents have also said that video really kind of brings them into the platform. And if you have these huge pieces of content, this must-watch content, as well as NFL games where you're sitting, glued to your screen for 3 hours, you have a captive audience. You can sell advertising. You can bring them back into the Amazon, ecosystem, selling more and more products. So it's kind of this flywheel effect, if you will.
Geetha, thanks a lot. Geetha Ranganathan, a Bloomberg Intelligence analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.